Nvidia reported earnings last week and the stock dipped about 5%, taking the company's market value to $4.2 trillion. But is there still time to buy the stock? Let's find out. With $57 billion of cash and $14 billion of debt on its balance sheet, Nvidia now has a total enterprise value of $4.16 trillion. Meanwhile, the company has generated $165 billion of revenue over the last 12 months, $87 billion of net income, and $72 billion of free cash flow. That means the stock is now valued at 25 times sales, 48 times earnings, and 58 times free cash flow. That may sound expensive, but Nvidia continues to put up staggering growth. Data center revenue hit $41 billion in the second quarter, an astonishing 56% growth rate year over year. Net income increased 59% to $26 billion, and the company's net income margin hit 57%. Nvidia achieved this without any meaningful contribution from China, which has faced new import restrictions. Growth is being driven by the continued boom in artificial intelligence and high-performance computing. At $4.2 trillion, Nvidia is now bigger than the economies of Japan, France, and the UK as measured by GDP, which is quite interesting when you consider Nvidia's current GPUs are likely to be obsolete in 5 or 10 years from now. True, newer chips will be needed to keep progress continuing, but there will come a time when Nvidia's rapid revenue growth will start to slow down. So let's consider a simple discounted cash flow valuation model that assumes 20% annual revenue growth for the next 10 years with free cash flow margins of 40%. That's against historical revenue growth rates of 39% over the last 10 years and free cash flow margin average of 30%. In this scenario, Nvidia would generate roughly $2 trillion of free cash flow over the next 10 years, and using a 10% discount rate and 25 times exit multiple, the fair value of the stock gets to roughly $208, which is 17% upside from today's price. That's not a lot of upside, and it relies on some quite optimistic assumptions. First, no company has ever grown so fast from such a large revenue base. When Apple hit $170 billion in revenue in 2013, its average growth rate over the next 10 years dropped to less than 9%. Second, the optimistic model assumes that growth simply continues in a straight line, but that is totally unrealistic when you consider the boom-bust nature of investment cycles. A more realistic scenario is that data center build-out quickly reaches capacity, AI progress slows down, and hyperscalers realize they've got all the chips that they need. At that point, demand for Nvidia's chips would plunge, and when you consider how much money is already going into AI data centers and how much power is needed to keep them running, we may not be too far away from such a peak. And the final risk is competition. Whenever a business generates huge profits like Nvidia, you can be sure that competition will eventually come in to try and take a piece of the pie. So Nvidia will continue to be a great business, but the stock looks risky from here. But these are my personal opinions, not financial advice, and I hold no position in Nvidia stock. For more investing ideas, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.